Last episode, we called Applied Materials the broadest toolbox in the fab. Today's company is the opposite shape. It's the deepest in the one single step that memory needs most. Lam Research. And if you wanted the purest, highest octane way to own the idea that the memory makers must expand, this might be it.
Because Lam owns Etch, the precise removal of material, atom by atom. It holds something like half to 55% of the entire etch market and over 80% at the most advanced node. And it's the most memory-levered of the big five. When Samsung, SK Hynix, and Micron build DRAM and stack 3D memory, they buy Lam's Etch by the billions. It just printed a record quarter too. So let's take it apart. Disclaimer first.
Quick, honest note before we dig in. This is just two curious people thinking out loud, for learning and for fun. It's not investment advice and never a buy or sell call. So always do your own homework.
Quick and clear. Education and entertainment only, not investment advice. Lam is a public example to teach this layer, never a recommendation. No buy or sell calls, no price targets. And the same caution as last time. These multiples conflict across sources, and the stock has moved fast. So verify any figure live. Do your own research.
The one-liner for Lam, the atomic scale etch monopoly, the highest leverage, highest beta way to own the memory build-out, and the one with the most China risk. So where Applied was breadth, but a touch less monopolistic, Lam is the mirror image, a deeper moat in its niche on a more concentrated, more volatile base.
Higher highs, lower lows. Basically, if the memory supercycle runs, Lam is geared to capture it more than almost anyone. If memory rolls over, Lam feels it harder. Depth and beta are the same coin. Here's the core why, and it's elegant. Memory scaling is fundamentally an etch problem. Modern DRAM packs deeper, narrower storage capacitors. 3D NAND stacks, 200-plus layers that have to be etched as near-perfect vertical channels straight through the entire stack. That's widely considered the single hardest etch in the whole industry. And high-bandwidth memory needs through silicon vias, deep holes etched to connect the stacked dies.
And Lam is the leader in all three of those. So a wave to double memory output is disproportionately a Lam wave. Its systems revenue is the most memory-weighted of the big five. In the last quarter, DRAM plus NAND and HBM made up something like 40% of system sales, far more memory tilted than its peers. And the conversion of older NAND capacity is being pulled forward specifically to feed HBM and AI. The Thesis runs straight through Lam's order book. The history is a clean story. Lam was founded in 1980 by Dr. David Lam in Fremont, California, to solve precision plasma etch as chip features kept shrinking. Its first product, the AutoEtch, set the standard for repeatability and made Lam the etch pioneer. For 3 decades, it was, essentially, the etch company.
The transformational move came in 2012, when Lam acquired Novellus Systems, which added deposition and cleaning, turning a pure-play etcher into a 3-pillar equipment major. And under the current CEO, Tim Archer, the doctrine has been hyper-specialization. Win the hardest etch steps, the 200-layer stacks, the new transistor designs, then monetize a huge installed base through services. Plus, a deliberate geographic shift to the US, Europe, India, and a new Malaysia fab to de-risk away from China. Structurally, 3 pillars plus a services arm. Etch is the crown. Number 1, that 50 to 55% share, over 80 at the leading edge. Deposition is number 2 or 3, around 15%, where Applied leads. And clean, removing contaminants after etch and deposition, where Lam is strong.
And then the quiet annuity, just like Applied, Lam's customer support business, spares, upgrades, and software on more than 90,000 installed tools, just hit a record around $2.1 billion in a single quarter. That recurring revenue is the ballast. When you've placed 90,000 machines into the world's fabs, you get paid to keep them running for years, cycle or no cycle. The technology is genuinely beautiful engineering. The signature hard problem Lam owns is the 3D NAND channel hole, etching a clean, straight passage down through 200+ stacked layers without it bending or tapering. To do that, they use cryogenic etch, running below -100 degrees Celsius for cleaner sidewalls, and atomic layer etch, removing material essentially one atomic layer at a time.
Plus the memory-specific work, the deep capacitor structures in DRAM, the through-silicon, via etch for HBM stacks, the transition to new materials like molybdenum for the word lines. It's co-optimized with their deposition. And the point of all that depth is simple. These are the steps that define yield in memory. Get the etch wrong, and the whole expensive wafer is scrap. That's why the pricing power is real. Run the 3-question screen. Question 1. Real bottleneck? This is arguably the strongest single-step moat in the group after ASML and KLA. Roughly half the etch market, over 80% at the leading edge, record gross margins near 50%, a 90,000 tool installed base. That's a near monopoly in its segment.
Question 2. Does the next generation help or hurt? It helps, powerfully. More NAND layers, gate-all-around, advanced DRAM, HBM vias. Everyone multiplies the number and the difficulty of etch steps. Etch intensity per wafer rises every single node, and Lam's depth compounds with it. But question 3. Can customers keep paying? That's the risk, and here it's bigger than Applied's, for 2 specific reasons. Lam is more memory concentrated and more China exposed. Deeper moat, higher beta. The numbers. The March quarter was a record. Revenue around $5.8 billion, up about 24% year-on-year, with a record gross margin just under 50% and operating margin around 35%. DRAM rose to about 27% of systems, NAND and HBM another 12%, and that customer support annuity hit its record. The next quarter was guided up again.
And management raised its forecast for the total wafer equipment market for the year to around $140 billion, above earlier views, citing AI and HBM directly. Korea and Taiwan were each at record levels. So the Samsung SK500 billion build and the Korea 1.3 trillion program aren't abstractions for Lam. They're showing up right now in the order book.
And one detail in that print is the clearest HBM tell of all. Older NAND flash capacity is being converted and pulled forward, specifically to make the kind of memory AI needs. So even within memory, the mix is shifting toward the highest value, most etch-intensive work. That's not just more demand for Lam, it's richer demand. The dollars of etch per wafer are going up, not just the wafer count.
On structure, in etch, Lam is number 1 at roughly 50 to 55%, with Applied and Tokyo Electron each under 20. So those 3 are more than 90% of the market, and Lam's leading-edge share is the closest thing to a de facto monopoly in its segment. In deposition, it's number 2 or 3 behind Applied. Across all of wafer equipment, Lam is around 22% share, number 2 or 3 overall, with no lithography and limited process control.
And the competitive watch, the bear's erosion lever, is that Applied and Tokyo Electron are pushing hybrid etch and deposition tools and next-generation atomic layer techniques, aiming right at Lam's crown. Any slip in that leading-edge etch share would hit the most profitable part of the business. When you're at 80%, the only direction share can surprise is down, so the watch is whether they hold it. Customers tell the beta story. Lam's biggest are Samsung, SK Hynix, and TSMC, a memory-heavy roster. Regionally, China is around 34%, Korea 23%, Taiwan 23%. Those 3 are roughly 80% of revenue. That memory tilt is exactly what gives Lam higher beta to the cycle. Better than its peers on the upswing, sharper on a glut.
Which is why management is deliberately growing the logic and foundry mix, now around 45% of systems, to dampen the memory swing over time. It's the same lesson as Applied. Concentration is the bull case and the bear case wearing the same coat. The customer who funds your record quarter is the customer whose pause craters the next one. Now, the single most important risk, and it's bigger here than at Applied, China. Depending on the quarter, China has been 31 to 42% of Lam's revenue, recently around 34%. That's materially higher than Applied's roughly 25%. And a lot of it is memory and mature node.
U.S. export controls already block the most advanced tools into China, and Lam refocuses on the allowed mature node business and offsets in the US, Europe, and India. But the honest framing is stark. A tighter decoupling could put something like 30% of revenue at risk. That is the single biggest idiosyncratic factor in this name, larger than Applied's China exposure, and it sits mostly outside the company's control and policy. You cannot analyze Lam without sizing that.
And it's worth being precise about the mechanism because it changes how you read the risk. It's not that China stops buying chips. It's that the most advanced tools are restricted. And a large slice of Lam's China business has historically been exactly the mature and memory mix that policy can squeeze. So the danger isn't a slow, gentle fade you can see coming. It's the kind that can step change on a single regulatory announcement. That's precisely why it sits at the very top of the risk list, above even valuation.
The financials are excellent and aggressive. That record quarter, revenue around $5.8 billion, gross margin just under 50%. Operating margin around 35%, earnings of about $1.47, guided higher again. Annualizing, that's something north of $6 of earnings for the year.
And the capital return is striking. Lam returned about 139% of its free cash flow to shareholders last quarter. More than 100%. That's a buyback-heavy program, plus a growing dividend, shrinking the float aggressively. The trade-off versus Applied is a lighter cash balance, around $4.8 billion versus Applied's $8 billion. It's a more aggressive, more shareholder-forward capital posture, which amplifies returns and, on the margin, leaves a little less cushion.
And to put a fine point on the aggressiveness, a big chunk of that buyback was done at an average price well below where the stock trades today. So on that tranche at least, the timing worked in shareholders' favor. The fair flip side is that buying back stock at today's much richer multiple is a lower return use of cash. A buyback isn't automatically good. It's only as good as the price you pay for it. That's a nuance worth holding for any of these names after a big run.
In the valuation, honestly, the stock ran from the mid-300s to around 432 in a matter of days, riding the Applied-led equipment rally, a market cap near $475 billion. On roughly $6 of forward earnings, that's something like 70 times trailing, 55 to 65 forward, against a historical range down in the high teens to 30. Very rich, just like Applied.
And here's the extra wrinkle. It's the same dangerous quadrant, a cyclical at a peak multiple on cyclically elevated earnings. But Lam's higher memory and China beta arguably make that multiple more fragile than Applied's. Not less. We're not telling you what to do with that. We're saying, if you're going to pay a premium multiple for the Purest memory lever, you're also buying the Purest memory risk. Those are the same thing. Both cases, plainly. The bull, the etch monopoly compounds. Every new layer and node multiplies etch intensity, and Lam's 80% leading-edge share captures it. It's the Purest lever on the Korea and Samsung SK build-out. Record margins, and that 139% of free cash flow return, and a Western diversification push that slowly reduces the China and memory single points.
The bear, the highest China risk in the group, full stop. The most memory cyclical profile, so a 2027 overbuild hits Lam harder than its broader mix peers. An extended valuation after a sharp run. Competition aiming at the leading-edge etch crown. And customer concentration in a handful of memory makers. The depth that makes the upside so clean is the same depth that makes the downside so sharp.
So, put the two episodes together because they're a natural pair. Applied is breadth. It touches every step. It's steadier, less China exposed, more cash on hand. Lam is depth plus beta. The etch near monopoly, the Purest memory lever, the higher China risk, the more aggressive buyback. Lam is the higher octane way to own the build-out. Applied is the steadier way. Both are high moat, both tier 2 cyclical, and both just ripped to around 70 times earnings. So neither is a chase here, on the framework's own discipline.
And the honest tension for Lam specifically, a genuinely deeper moat than Applied in its niche, the single best memory leverage in the whole group. Sitting on the most cyclical and most China-exposed base, priced for the supercycle to keep running. The 2026 and 2027 earnings seasons and that overbuild question are the verdict. We don't predict. We test the thesis as the evidence lands. Next in the series, we move from the tool makers to the yield police, KLA, the process control monopoly. Thanks for spending part of your day with us, and tell us in the comments, would you rather own the broadest moat or the deepest one? And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one, and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.